Welcome to today's Explainer. We're unpacking a really intense situation happening across global raw material markets as of August 21st, 2026. If you've been watching the markets lately, you know things are pulling in wildly different directions right now. It's an absolute tug of war, and it's directly impacting everything from the cost to fill your gas tank to the price of your next smartphone. So today, we're going to break down exactly what's going on, look at the hard data, and lay out the future price outlook for 6 major raw materials. Let's dive right in.
We've got a packed agenda for you. First, we'll look at the macroeconomy and geopolitical risks. Second, crude oil's volatility in the Middle East. Third, the massive return of gold and silver as safe havens. Fourth, palladium's unique dynamic with AI and autos. Fifth, the deepening supply crunch for copper and nickel. And finally, we'll wrap it all up with our comprehensive 2027 commodity outlook. All right, kicking things off with Section 1, Macroeconomy and Geopolitical Risks. Right now, the global economy is caught in a fascinating and frankly stressful tug of war. On one side of the rope, the 60-day U.S.-Iran Memorandum of Understanding just expired without an extension. The resulting secondary sanctions targeting oil smuggling and shipping have absolutely spiked geopolitical fear across the Middle East. But on the exact opposite side, we have easing inflation. The cooling U.S. CPI data, which is down to 3.4%, has dramatically lowered expectations for aggressive Federal Reserve rate hikes. These two incredibly powerful, distinct pressures are essentially pulling the commodity markets apart.
And you can literally see that split happening right here over the last year and a half. Safe haven assets and precious metals are surging upward, riding on a wave of financial shifts and geopolitical fear. Meanwhile, industrial metals, they're wrestling with an entirely different beast: complex, physical supply chain disruptions.
That brings us to Section 2, Crude and the Volatile Middle East.
Driven by the U.S. pivoting to those stronger economic sanctions against Iran we just talked about, crude oil recently smashed right through the $90 mark. Now, there is a heavy shadow fleet out there, vessels bypassing official tracking, and maximized detour pipelines that are helping maintain Gulf exports at around 15 million barrels a day. But despite that, the market is completely on edge. Looking ahead, the forecast anticipates Q4 prices hovering tightly between $80 and $100. And really, that's going to heavily depend on how these geopolitical events unfold as we barrel toward upcoming elections in both the region and the U.S. But here is the hidden constraint that nobody's really talking about. A critical factor limiting any potential government intervention to cool off those rising prices is that the U.S. Strategic Petroleum Reserve has drained down to just 300 million barrels. Now, that sounds like a lot, right? Well, until you realize that's actually its lowest level since 1983. Entering 2027, the policy buffer to fight off a sudden supply shock and a resulting price spike at the gas pump is incredibly thin. Let's shift gears to Section 3, Gold and Silver and the Return of Safe Havens. Before we look at the actual price charts for these metals, we absolutely have to understand the macroeconomic drivers propping them up. First, the probability of a U.S. Fed rate hike in September plummeted from 50% down to 30%, which weakens the dollar and makes metals way more attractive. On top of that, U.S. federal debt just surpassed a staggering $40 trillion for the very first time this August. Throw in surging tech demand and relentless buying from global central banks, and you've got a literal perfect storm for safe havens.
Driven by those exact factors, gold has been on a historic run, bursting past the $4,000 mark. And honestly, even with some easing in inflation fears, the fundamental foundation for gold is rock solid right now. The current forecast expects gold to maintain this upward trajectory, likely testing resistance levels around $4,500 over the next 12 months. And what's truly staggering here is the sheer volume of central bank accumulation driving that baseline. Just to give you a sense of scale, the People's Bank of China alone has stockpiled 2,366 tons of gold over 21 consecutive months. That kind of sustained, massive institutional buying creates an incredibly strong floor for the price.
Silver is riding a very similar macroeconomic wave, but it's getting an aggressive extra boost from the industrial side. Global investment in AI is driving massive electronics demand, and the EV sector is just booming. I mean, China's new energy vehicle market share just crossed a massive 60% this past July. Because of that, the industrial appetite for silver is absolutely insatiable right now.
So here is the crucial takeaway. While this AI and EV demand is skyrocketing, the physical supply is actually shrinking. Global silver mine production has fallen to just 92% of the levels we saw a decade ago. We're now looking at 5 consecutive years of global supply deficits.
When you have surging future tech demand meeting a shrinking physical supply, the upward pressure on price becomes highly structural. It's baked in.
Moving on to Section 4, Palladium, AI, and Automobiles. Palladium is in a really interesting spot. It's now facing its 6th consecutive year of supply shortages. Even with some broader economic slowdown fears, which typically suppress industrial metals, this sustained multi-year supply deficit is severely limiting any downward price movement. It's creating a surprisingly resilient floor for the metal.
The polarization here is clear as day. On the demand side, you've got booming hybrid vehicle sales in the US and Europe, plus massive spikes in demand for MLCCs. Those are the microscopic ceramic capacitors essential for AI data centers. But on the supply side, Russia's Norilsk, the #1 palladium producer in the world, just saw its first-half production drop by a stunning 14.4%. Its surging modernized demand colliding head-on with failing legacy supply. Let's look at Section 5, Copper and Nickel, and their deepening supply crunch.
Copper is famously the bellwether for the global economy. Basically, everything from housing wiring to electronics feels this pinch. And right now, it is under immense global supply pressure. In the first half of this year, mine production in Chile, the world's top producer, was down 6.6%. On top of that, key Indonesian smelters had to halt operations in August because of critical facility defects. With this compounding squeeze, forecasts show copper prices are positioned to break $14,000 this year and potentially push past $15,000 in 2027.
Nickel is mirroring this intense physical constraint. It's being driven by massive demand for stainless steel and green infrastructure, while simultaneously facing severe refining bottlenecks. Because of this, the global nickel market is projected to tip into a structural supply deficit this year, for the first time since 2022. How did we get there? Well, it builds into a fascinating real-time domino effect. Step 1. China's sulfuric acid exports unexpectedly fell off a cliff, plummeting by over 99% in June and July. Because sulfuric acid is critical for refining, this sudden drop directly kneecapped Indonesian wet smelting operations, totally starving them of materials. Consequently, Indonesian smelting production costs surged by up to $2,600 per ton, which ultimately pushed the entire global nickel market into that deficit we just talked about. It is a textbook example of how fragile these interconnected supply chains truly are. All right, bringing it all together in Section 6, our 2027 Comprehensive Commodity Outlook. As we synthesize all this data from August 2026, the overarching theme is undeniable. It's a tale of two entirely distinct markets diverging based on completely different drivers. We have precious metals and energy swinging wildly based on geopolitical fear, interest rates, and national debt. Meanwhile, your industrial metals are completely detached from that financial sentiment, reacting almost exclusively to sheer physical supply chain disruptions and critical material deficits. This 12-month correlation matrix paints the picture perfectly. Notice the incredibly tight positive correlations among the precious metals. They're moving in lockstep. But then look at crude oil. It has negative correlations with gold and silver, and practically zero correlation with copper. It's trading completely independently of almost everything else, just trapped in its own geopolitical bubble. The data makes it crystal clear. The era of unified commodity trends is basically over, replaced by this hyper-polarized landscape. So I want to leave you with this final thought as these massive forces continue to reshape our global economy heading into 2027. With persistent supply deficits plaguing the metals critical for our tech future and geopolitical tensions escalating daily, are we entering a new supercycle where raw materials dictate the literal ceiling of global growth, or will a broader slowdown in manufacturing eventually cool the fire? It's the multi-trillion-dollar question. Thanks so much for joining us for this explainer, and we'll see you next time.